The Hong Kong Stock Exchange is set to become the #1 market in the world for IPOs this year, although it's running neck and neck with the New York Stock Exchange and NASDAQ. It's been a really good year, $32 billion raised. However, big fly in the ointment is more than two-thirds of the companies that have listed are already trading below their IPO price. Robyn, what happened here? We had some really good news, and now the markets are on the slide, but it seems like there's a deeper problem with the issue. What's going on in Hong Kong?
That's right, Pete. So, Hong Kong had a really big year for IPO this year, and that's largely due to a lot of the tech companies that are listing in Hong Kong because of the newer rules that allows dual-class shares and weighted voting rights. So you have Xiaomi, you had Meituan. But unfortunately, like you said, the secondary market performance has been really bad. So over two-thirds of the company, around 70% of new listings this year are now trading below their offer prices.
And this was a big push by the head of the exchange, Charles Lee, to kind of tweak the rules, allow weighted voting rights, stuff like that, to get these guys on. But now it's become obvious, that there's still all these unsolved problems with the exchange if you want to come on and trade.
Yeah.
What is the holdup here?
So trading volumes is actually quite low in Hong Kong. On average now, based on this year's numbers, Hong Kong will average roughly $14 billion worth of trading a day. That compares to Amazon, on the NASDAQ, which has, over $13 billion of stock trade hands just for that one company alone. So you can see that Hong Kong, there is very poor liquidity, particularly in the secondary market here.
There's been some dissatisfaction with this, but we don't seem to see a lot of like delistings. There's one, Hopewell, I think, is trying to do a take private. But in general, it seems like the liquidity, the trading is locked up by some of the biggest listed companies, and these small guys molder on the sidelines. What's up with that?
Yeah, so you have, like you said, the Tencent alone, accounts for over 10% of daily trading in Hong Kong. So, out of the 2,000 or so companies listed in Hong Kong, you do have, over 1,000 that have very poor liquidity, and like you said, very little exit options. The hurdles are quite high for take privates, for privatization, for private equity buyouts, for various reasons. One of them is that minority shareholder protection is quite high in Hong Kong. So 10% of minorities can block a bid.
Well, is there anything that's being done to fix it or address it? I know bankers complain about the retail investors, and they say people just jump into IPOs, and the second it looks like they're not going to go crazy, they sell. And
it is. It's definitely a very tough issue to tackle. There is sort of a chicken and egg element here, where to attract quality long-term investors, you do need quality, strong companies, and vice versa. So then, with the new IPOs coming on, that's starting to change. But then getting the investors in, and not just speculators to come in for IPOs, it's definitely a different matter.
Well, so I guess it's not a bad victory for Hong Kong, but New York doesn't have anything too much to worry about and being significantly displaced just yet, huh? All right. Well, thanks for talking to me, Robyn. Thanks for watching, everybody.